Roar here with the aftermarket analysis and outlook for Tuesday, October 1st, 2013. And it was quite an interesting day, and we're going to focus substantially only on the S&P 500 future today because much else remained very constant and steady with our assessment of the broader global asset classes from over the weekend. And the U.S. equities were really a standout today, and we'll mention this in the context of what went on elsewhere a bit later on. But as opposed to the rollback over into downside weakness one might have expected on a U.S. government shutdown coming in from midnight this morning on Tuesday the 1st, we ended up with a market that was pushing up back above 1680 to 82 within the first hour. That put the buy signal that was already inherent in the close from the end of the day going back to the hourly stochastic on Monday into better shape, reversed the 30-minute minor down signal into an up signal, and basically put the indicators on the upside. Especially important here in the 60-minute MACD, where you had been still on a minor chance for a downside runaway below the runaway band that was quickly reversed in the morning. And all of this looks very constructive on the degree to which the market's back above 1682 to 78 on one hand. On the other hand, stepping back and looking at the broader picture, being up into the 1688 to 95 area with a high late today, of course, at around 92, was not really yet convincing. And as we have discussed in various other analyses, the point of all this is that as good as the rally looked, it was based upon somewhat specious macro technical grounds. The consideration that the U.S. shutdown might only last a couple of days, which in this case doesn't look likely for reasons we've noted elsewhere. At length, in fact, quite a bit of discussion of that. The idea that even if it lasts a while, it will constructively somehow fold into a broader debt ceiling negotiation that will already be well down the road because of the various missives back and forth between the Republicans in the House and Senate Democrats. But we don't see that. These positions are too entrenched and too far afield in terms of what's even under discussion, as the right wing of the Republican Party continues to look at the Obamacare Affordable Care Act, as it's known, officially, and Obamacare, as is its nickname, and look for ways to defund it or in other ways hamper it out of this budget negotiation, which the Democrats just aren't buying. So we think this could get a bit more pernicious again. And what we have in the intermediate term is therefore something that is a little less constructive looking insofar as the gap higher 2 weeks ago on the summer's withdrawal from the Fed head race left a low of 1695 after closing on Friday the 13th at 1688.60, and there was your runaway gap to the upside. Well, lo and behold, what happened on anticipation of the coming contentious shutdown in the U.S. was a close back down at 1686.40. In other words, below the bottom of the gap last week. This classically turns this upside runaway gap that should have been a fillip for a push to higher levels, maybe even up into the mid 1700s, into a top. And basically the top spans the range of the gap. So while the push back above the daily chart level at 1682, with 78 to 82 being the support that was violated on Monday's close, the pushback above there looked kind of interesting, and we had been anticipating if it got back above 84, it could push somewhat higher. In fact, on the continuation picture is only partly back up into the gap that was left on the upside a couple of weeks ago and is now the resistance. So, pending any ability to get above and close above 1695 on a weekly close, if those fundamental psychologies we found rather specious don't hold up and the market should come back under pressure, this is still a topping action over the past several weeks that would lead to likely further erosion into deeper supports. The bigger one remains and is reinforced now after the new high by the upward revision of this Fibonacci level. It remains right into the 1630 to 25 area, and above that on the daily chart would be the upbreak out of the downward channel from the early August high, and that's in about the 1643 area. So that's what we see there, and we're going to return to another look at the short-term charts and just a quick mention of how little anything else really moved. And interestingly enough, in spite of the U.S. equity strength, there was not that much strength elsewhere. The other equities were about steady, and the 10-year note and the other govies held up very well in the face of the U.S. strength. 10-year note futures still being above 126, the gilt being above 110.20, and the Bund only backing off into the 140 10 to 140.30 area, and that would be the degree to which it was all holding up very well. And the US dollar still only had a modest bounce after trading slightly below 80 even on the dollar index from early on. The euro held around 135. Sterling is still pushing up nicely above 160 on what looks like a run to its 163 area resistance. And in fact, the Australian dollar was stronger than not, having pushed up very nicely from its 92.80 to 40 support up toward 94 against the US. And the yen, even though the dollar tried to rally a bit, dollar yen still stalled at 98.80. So all in all, it still appears to be a market that does not particularly look like any of the other asset classes are reflecting a real sustained return to strength in the U.S. equities as a potential leader of the others, and we'll have to watch very closely to see if the December S&P future can either get above the 1695 area on a sustained basis to knock out that near-term top from the gap failing, or if it ends up back below 1682 to 78, would more so be reinforcing the degree to which this was a temporary top of the month, top of the quarter rally reinforced by some U.S. shutdown psychologies that are not going to end up as constructive as some people had hoped. That's it for now. We look forward to updating you again after Wednesday's close, and don't forget, early ECB meeting this month. Thursday, German Unity Day holiday, means that the ECB is meeting tomorrow morning with the typical influential press conference to follow. Bye for now.